Okay, let's unpack this. We're jumping into a deep dive today on two very different real estate investment trusts, or REITs.
Yeah, really different. Based on the sources we've looked at, it's like comparing apples and, well, something completely else.
Exactly. They might both be REITs, but the sources paint them as living on different planets almost.
They really do. And the core question the research digs into is pretty sharp. Are we looking at a safe cash flow king, built for reliable income, or is it more of a high-risk comeback situation, basically fighting for survival?
Right, and the two companies we're focusing on. Realty Income, ticker O, the one known for that monthly dividend.
The monthly dividend company, yeah.
And the other is Medical Properties Trust, MPW. So our mission here is pretty straightforward. We're going to quickly break down what these sources are highlighting about their valuation, the dividends, cash flow, balance sheet.
How diversified they are, the risks involved,
Yeah.
all that good stuff.
The idea is for you to get the key differences the experts are pointing out and, where they kind of land on these two.
Basically distilling the main insights from the report so you don't have to wade through everything yourself. Let's dive in.
Okay, first up, value. How do the sources figure out what these companies are, actually worth, their intrinsic value?
Well, they use the standard tools like discounted cash flow, DCF, and dividend discount models, DDM. These try to project future value based on expected cash flows.
Right.
But they also look at net asset value, NAV. That's basically looking at the real estate they own, subtracting the debt, kind of like the liquidation value almost.
Gotcha. So what did they find for Realty Income, for O?
Okay, for Realty Income, the DCF and DDM models, they seem to peg its value somewhere around $55 to $56 a share.
Which is pretty close to where it's been trading around.
Yeah, exactly. So based on those cash flow methods, it looks, fairly valued.
Yep, I sense a but coming.
Well, yeah, because the NAV, the net asset value calculation, the sources suggest that points to maybe more upside, closer to $70, maybe even a bit higher.
Oh, interesting. So based on its actual property value, it might be, what, like 20% undervalued?
Potentially, according to that metric, yeah. But the overall conclusion from the sources seems to be that it's fairly valued when you factor in the low risk profile.
Okay, low risk, fairly valued. Now, what about MPW, Medical Properties Trust? I have a feeling this is where it gets different.
Oh, dramatically different. The DCF model cited for MPW, the range is just huge. Like from $5 on the low end all the way up to $15.
Now, 5 to 15. That's a massive spread. And where's stock price now?
Much lower, hovering near $4.60 or so.
Okay, so a big disconnect between some potential values and the market price.
Sure.
What about its NAV, its book value?
The research puts that around $7.93 per share. So yeah, it's trading at a pretty deep discount to book value, something like 0.6 times.
On paper, that sounds incredibly cheap, like a potential bargain.
That's the thing, right? It looks cheap. But this is where the sources really hammer home a key point: the immense uncertainty surrounding MPW.
Uncertainty. How so?
Just a lot of questions about its tenants, its debt, its future earnings potential. And that cloud of uncertainty, according to the analysis, really overshadows any potential upside you might see just from that NAV discount.
Okay, so connecting this back for the listener, understanding DCF, NAV, all that, helps you gauge potential value versus the current price. But the big takeaway from the sources seems to be that risk completely changes the game for MPW.
Absolutely. Risk isn't just a footnote here. It's central to the whole valuation story for MPW.
All right, let's pivot then. Let's talk dividends and the cash flow that, hopefully supports them. The sources mention FFO.
Yeah, funds from operations. It's a really key metric for REITs. It's generally seen as a better gauge of their operating cash flow than traditional earnings, and it's what they typically use to pay out dividends.
Okay, so Realty Income's dividend picture, I imagine the sources confirm the usual story.
Pretty much. They highlight the yield, which is around 5.5% to 5.8%, and of course, that incredible track record growing the dividend for over 26 years straight.
That's stability right there. What about the payout ratio? How much of the FFO are they paying out?
It's around 77%, which is, sustainable for a REIT like O. The projections cited for 2025 show FFO around $4.25 per share, easily covering a projected dividend of about $3.22.
So the sources basically confirm O is steady, growing, super reliable for income.
Exactly. That's the picture they paint.
Now, shifting to MPW.
Yeah, I'm bracing myself. The dividend situation there.
Yeah. The sources are pretty blunt. It got slashed big time. It used to be $1.16 per year. Now, just $0.32.
Wow, quite a cut. So it's the yield now. And the payout ratio?
Well, the yield is still around 6% or 7%, which might look okay on the surface, and the payout ratio is now technically low, around 40%.
There's always a but with MPW, it seems.
Right. The sources are very clear
Yeah.
that low payout ratio isn't a sign of health. It's only low because the FFO, the earnings, just crashed.
Ah, okay, so the denominator shrank massively. Precisely. The analysis shows FFO declining in 2024, projected around $0.80. The sources call it a major income reset for MPW, and they see any recovery as, well, uncertain.
So, for you, the income investor listening, this contrast couldn't be starker based on the sources. O means consistent growth, MPW means a recent deep cut, and a very cloudy future for that income stream.
That's the crux of it, yeah. It really highlights the difference in dividend reliability.
Okay, let's move beyond just the income payout and look at the foundation, the
Yeah.
balance sheet. How financially healthy are these companies, according to the research?
This is crucial, right? It shows their ability to handle debt, weather storms, access capital if needed.
And for Realty Income, what do the sources say?
They describe it as a fortress balance sheet. Simple as that. It's got an A-rated credit rating, which is excellent for a REIT.
A-rated, wow.
Yeah. Low net debt to equity ratio, around 0.8 times, strong liquidity, and importantly, it can borrow money relatively cheaply because of that strength.
Right.
Low risk of financial trouble.
Fortress sounds about right.
Okay.
Now, MPW's balance sheet, let me guess, not quite a fortress?
No, not even close, according to the analysis. The credit rating is way down at CCC plus LE. That's deep into speculative or junk territory.
CCC plus, okay. And the debt levels?
Much higher. Net debt to equity is around 1.5 times. But the really alarming thing the sources highlight is what they call a huge debt wall.
A huge debt wall. What does that mean exactly based on the sources?
It means a very large amount of their debt comes due, needs to be repaid or refinanced, specifically in 2026 and 2027, just a couple of years away.
And refinancing could be tough with that credit rating.
Exactly. The sources state its access to capital markets is very limited right now. It's a precarious situation.
And they even quoted the S&P assessment.
They did. S&P's view, as cited in the reports, is pretty damning. They called MPW's situation an unsustainable capital structure.
Unsustainable, wow.
Yeah. So the sources conclude that, financial distress is basically priced into MPW's stock already, and, as they put it, and for good reason.
So again, just a massive difference in financial stability laid bare by the sources. O looks solid, while MPW has this major debt issue looming, a huge risk factor.
Absolutely. It's one of the biggest overhangs for MPW mentioned.
Okay, let's talk diversification. How spread out are their businesses? Does that help mitigate risk?
Definitely. Spreading bets across different properties, tenants, even industries helps cushion the blow if one area struggles.
And how does Realty Income stack up on diversification, according to the sources?
Incredibly well. They own over 15,000 properties. Think about that number.
15,000, that's huge.
Yeah, and lease to over 1,200 different tenants. And get this, their single biggest tenant makes up less than 4% of their total rent.
Less than 4%. So no single tenant can really sink the ship.
Pretty much. Plus, they focus on necessity-based retail places like grocery stores, convenience stores, drugstores, stuff people need regardless of the economy.
Makes sense. Stable businesses.
And the metrics back it up. The research points to 99% occupancy. Plus, about 40% of their tenants are investment-grade rated companies themselves. So the picture is highly diversified, very stable tenant base.
Okay. Now, MPW, how diversified or maybe concentrated is it?
Much more concentrated. It owns around 400 hospitals, which is still a lot, but far fewer than O's portfolio. And only about 50 or so tenants operate those hospitals.
Fewer properties, fewer tenants.
Okay. And the sources make a big point about its past concentration with one specific tenant, Steward Healthcare.
Ah, yeah, Steward. That name has been in the headlines.
Right. At one point, Steward accounted for something like 30% of MPW's rent. 30%. And Steward, as we know, went bankrupt.
Ouch. That's a massive exposure.
Yeah.
What's the situation now?
Well, MPW has been working to release those properties to other operators, but the sources emphasize that the risk associated with that whole situation, it still lingers. It's not fully resolved.
And MPW is focused just on hospitals, right?
Exactly. It's a pure play hospital REIT. So all its eggs are in that one basket, the healthcare real estate sector, specifically hospitals. The source's conclusion on this, that high concentration equals high fragility.
Yeah, you can see why. If your main customer goes bust or your single sector faces headwinds, you're much more exposed. So O's broad diversification makes it way more resilient, according to the sources, compared to MPW's focused, maybe even fragile approach.
That's the takeaway, definitely. Resilience versus fragility.
All right, last major comparison point. Macro risks and volatility. How do things like interest rates or market sentiment affect these stocks? And how jumpy are their prices?
Good question. External factors always play a role. And volatility, often measured by beta, tells you how much a stock tends to swing compared to the overall market. A beta of 1 means it moves with the market. Lower means less volatile, higher means more.
Okay, so Realty Income, how sensitive is it?
Like most REITs, it is sensitive to interest rates. When rates go up, REIT stock prices, including O's, often go down, at least initially.
Right, the yield competition aspect.
Exactly. But the sources make a crucial distinction for O. Even when its stock price dropped because of rising rates, its actual business fundamentals, occupancy, rent collection, remained remarkably stable.
So the business kept chugging along fine, even if the stock price reacted.
That's the picture painted. And its beta reflects that relative stability. It's low, around 0.5, meaning it's generally much less volatile than the overall market.
Okay, stable underlying business, low volatility. Now, MPW, risk exposure.
Very different story again. MPW is described as being highly exposed to the debt markets, given its balance sheet situation we just discussed.
That debt wall.
Yeah, its ability to refinance or raise money is directly impacted by conditions in the debt market. The sources actually say it's trading like distressed credit.
Like distressed credit, that's a strong statement. And its volatility, beta.
Much higher, around 1.4 according to the research, so significantly more volatile than the market. Its price swings are much more extreme up and down.
So it amplifies market moves.
Pretty much. The sources conclude that investing in MPW right now isn't really about buying a stable income stream. It's fundamentally a bet on a turnaround, a recovery story.
Got it. So if beta measures wildness, O is calm and steady, while MPW is much more volatile, reflecting how the market sees its higher risk and speculative nature.
That sums it up well. The volatility reflects the underlying uncertainty and risk.
Okay, let's pull all this together then. After looking at valuation, dividends, balance sheets, diversification, risk, what's the final verdict from the sources on these two very different REITs?
The verdict is pretty clear-cut based on their analysis.
For Realty Income,
It's summed up as the conservative core, reliable income, that 5%-ish yield, the fortress balance sheet we talked about. It offers maybe modest upside potential, but the key is low risk.
so ideal for someone focused on steady income.
Exactly. The sources position it as perfect for income-focused, lower-risk strategies, sleep while at night investing maybe.
Okay, and the verdict on Medical Properties Trust, MPW.
It's firmly labeled a speculative high-risk bet. Now, the sources do acknowledge that if, and it's a big if it survives its current challenges and manages to rebound, then there could be big upside from today's beaten-down stock price. But they are absolutely clear it's a turnaround play. It is not a dependable source of income right now.
And they had that analogy, right?
Yeah, a pretty vivid one. If you want dependable monthly income, O is the obvious choice, MPW. They described it as a lottery ticket wrapped in a hospital gown.
Wow, okay. That paints a picture.
It does.
Yeah.
And the advice that follows is just as direct. Approach MPW only if you can afford to lose what you invest. So the final choice presented by the sources really boils down to sleep easy or roll the dice.
Sleep easy or roll the dice. That really captures the contrast. So thinking specifically about MPW and that unsustainable capital structure, the huge debt wall coming up, what kind of things would actually need to happen realistically in the next, say, 2 to 3 years for that potential big upside the sources mentioned to materialize? What's the path out look like? And based on the source material, how likely does it seem?
That's the multi-billion-dollar question, isn't it? It probably involves successful asset sales at good prices, stabilizing tenant issues, maybe finding a way to refinance that debt even with the poor rating. A lot has to go right. It really forces you, the listener, to think about your own goals and risk tolerance. Are you looking for the stability of, the sleep easy option, or does the potential reward from MPW's high-risk turnaround, that roll of the dice, align better with your strategy, keeping all those significant risks highlighted by the sources firmly in mind?